So predominantly gold has been a emotional asset actually, though it's a financial investment for many of the people for a very long time who doesn't have access to formal banking system and all. So it's been a storage of value for quite long time in India, which got associated emotionally to and also religious as well as. Silver again is traditionally seen as store of value, but at the same time, silver jewelry, silver utensils have been a predominant driver for both of
Yeah,
these.
okay.
Um, when we look at both of these
You can mail me
metals
also. I am mail
in
यहाँ पे
Indian perspective,
कर सकते हैं या फिर click पे डाल सकते हैं उनको बोलो mail.
I think I'm getting some disturbance. Yeah. So looking at the financial from the financial perspective itself, um, both the metals have their own advantages and disadvantages. As we put them in the same basket as precious metals basket, which also contains platinum, palladium, gold, and silver. Though platinum, palladium goes further into the industrial use than into the precious side of the basket. So if you put it into that setup, so gold being the most precious and non, in a sense, a store of value, to platinum being the least, the precious side, and even the palladium being the least precious side, which goes into more further into the industrial side. As far as returns are concerned, actually, if you look at the last few years, it has been what you call a roller coaster journey for all the asset classes last 2 years. So we put a chart like with all the indices, basically Nifty, S&P, and Japanese Nikkei, along with the gold prices. So you can see that the initial portion of where the pandemic hit us, the gold performed, the dark black line has been gold. So gold performed much better than equities as an asset class. Then predominantly from Jan 21 onwards, it started to underperform the equity as an asset class, even the developed markets as well as emerging market equities. Now, I think most of the 22 from the beginning of Jan 22, most of all the, including gold and silver and the equities, have become marginally corrected and also actually become a sideways and chaotic in nature. But you understand when equities perform or the gold basically being a hedge against inflation or as a value, a store of value, it doesn't really put up that much. But at the same time, when there is a bad broader economic period or a recessions or high inflationary scenarios, typically gold and silver perform uh, uh, better than the equity as an asset class. So I think the right side chart actually shows how the global inflation trends have been. Again, it's no surprise there. Europe has seen a significant rise in inflation, driven by both supply side issues as well as the conflict and energy related issues. So we all know that there are no surprises there. So inflation is rising. Absolutely, there's no debate over there. So further looking at expectations, how the future expectations of inflation in US is there, even that's trending much higher. At the same time, we also see global growth concerns coming up. uh, the debate right now is only either we are already into the recession or recession is coming, whether it will be a prolonged recession or whether it will be a short-lived recession. So these are the debates, but there is no debate that we are not going to hit a recession. So there will be a lag on the growth front, and definitely the higher interest rates will impact the growth, and undoubtedly recession is coming. So in that sense, when we look at the asset classes per se, the asset classes which will come which will add value to your portfolio during those high inflationary scenarios, especially when the growth is falling, is going to be the precious metal complex, especially the gold. But you might say that yes, inflation is already showing up on the charts, but gold has been going down, and uh, so why is it happening? So typically, gold, for any rally or a significant rally in gold, it needs two major ingredients. The number one is uh, liquidity, or the lot of money, the money supply, and the second one is the cost of money. That's so lower interest rates, higher inflation, which is driven by liquidity, actually makes a perfect recipe for a gold rally, because you should have too much money without too much of cost of having it. So because gold being a non-yielding asset, whenever the cheap money and too much of money is there, basically gold rises significantly. But I think off late, 21 onwards, or 2021 onwards, actually, gold has been facing a significant competition from crypto as an alternate asset to gold, in order to protect against inflation. It has become primary asset which will give you protection against inflation, and a lot of people started believing it. But we all seen that early 22 onwards, where the crisis hit the cryptos, I think it lost that value altogether, because the volatility doesn't justify the nature of crypto as an alternate for gold. So that actually has gone off. So now there are only two safe havens in the world. That's one is US dollar, the other is gold. So both are actually typically currencies. One is regulated and controlled by US, and second is priced in dollars. So I think they are the two only things. But today, at this point of time, if we are looking at last couple of months, especially, US dollar emerged as the only safe haven rather than gold itself, because there and gold started falling. So though we have a major geopolitical crisis going on, we have a major inflation issue, and we have threat of recession on our hands. Uh, so despite all these things, gold didn't perform, because number one, the biggest enemy of gold is rising interest rates. So as far as the interest rates are rising, the gold will start to feel that heat and the headwinds from the interest rates. Second is, because the gold is priced in dollar terms, as the dollar is rising against most of the other currencies, partly with the strength of US economy, but largely due to the weakness in other currencies. Actually, it could be euro, off late GBP, and some of the emerging market currencies. So it's not only the strength of dollar, it's also the weakness of other currencies, making dollar much stronger than what it should be, or what its economy portrays it. But at the same time, so the higher dollar means any asset which is priced in dollars will go down. It's a simple mathematical calculation. The higher the value of dollar, you pay less amount of dollars for the same asset value. So gold predominantly is not falling, but because it is showing mathematically lower value, because the dollar has been appreciating, and to some extent, when we are sitting in India, when we are pricing our gold in rupee terms, the dollar appreciation is also means rupee depreciation. We are cushioned by that rupee depreciation in India, to some extent, but not largely. So we have also seen the price drop in India, but not to the extent what we have seen in the international markets. So how is it going to be? I think we have seen interest rates rising much faster than what many people have anticipated. And at the same time, the rate hikes have been much larger in nature, which actually tells us that the rate hike cycle, the entire rate cycle will not be prolonged like 2-3 years. It might be very short run, probably another 6 months or 6 months or 9 months, where we could expect rates to peak out, at that point of time where the recession will be evident, and the economy slows down, the purchasing power erodes at that point of time, where we can see that pain coming up at the consumer end. That is where actually we could see that the rates peaking out, and dollar peaking out, and probably at the same time gold should be bottoming out. So in our view, somewhere in the next 6 to 8 months, this turnaround will happen. As far as silver is concerned, again, when we look at silver, especially even last, we can say that 15-20 years also, it actually has a bouts of sideways to marginally corrections, and then you will have a significant upside. Then it has a consolidation, it has an upside, and now correctly we are in the corrective downturn. So what happens to silver from this point of time? So I can actually divide these periods into two different things. So one is pre what you can say, the green fuels, and post the emission norms tightening across the globe, and environmental sensitivity came in. So I think silver actually is playing a predominant role there, either in photovoltaic cells like solar panels, or in majority of the tech related and even EV related technologies. Silver plays a significant role, including IoT, the Internet of Things. There's a lot of in nanoparticles, silver is getting used. So silver's industrial consumption has been on the rise. That's typically the chart which we are showing here. You can see that the speed or incremental growth of silver as an industrial commodity, and the demand has started increasing from 2020 onwards. That's where actually the dynamics or the fundamentals of silver changed forever. It's no more a precious metal, it's more an industrial metal with the rarity or the limited amount of silver available as a metal. So unlike aluminum, or unlike other non-ferrous metals, where the supply is easy to obtain, but silver is a very different in that manner. And also silver is there are extremely rare cases of silver mine being operated. Silver is never operated as a single mine, or silver mining doesn't happen. Silver is always a byproduct of many other mining or metals. So it could be part of iron ore, it could be part of copper concentrate, it could be part of nickel, lead and zinc. So all the non-ferrous or ferrous metals, especially on the non-ferrous side, when you smelt them, you get silver as part of that. You get some of the gold and you get some of the silver as well as part of that. So silver always emerges as byproduct of industrial mining. And so the control of quantity of silver, whenever you want, you can't really boost it up, or you cannot reduce it up, because being a alternate or a secondary metal, so the miners doesn't even hold silver, or if they want more silver, they can't really increase the silver, because by doing so, actually they will be impacting their primary metal. So it's very difficult, or it's very really not possible to really uh, uh, have the price elasticity to the supply, actually, whether the price will really drive the supply, or whether the price will actually shrink the supply. Either ways, it is really not that connected to the price. So when you see the supply side, actually the demand has been increasing since 2020, where we're looking at around 1100 tons of demand, and supply should be marginally lower. In 22 forecasted, where 21 we had a marginal shortage, and 22 also will have a marginal shortage or deficit of silver supply compared to the demand. But anyway, so we have actually dipped into market deficit as far as demand supply is concerned in silver. since 21 and 22 is also expected to be that. So as this price pattern, which I've shown in the earlier slides, it might not repeat, and probably here onwards, it will act more as a fundamental based commodity, which is driven by demand and as an industrial metal rather than a precious metal. So when you constitute a portfolio which contains gold, as gold itself has seen as a hedge against inflation, hedge in your portfolio against the global risk. But in that portfolio also, when you look at the overall contribution of gold, I think at times gold becomes a currency rather than an asset. And for Indians especially, gold becomes another way of holding dollars. So instead of holding rupees. So that way, what our forecast today is like, medium term, we might be having a much milder returns. But in a longer term, when you're looking at 2 years or so, probably silver is expected to perform at 28-30% upside, whereas gold is expected to give us roughly around 17% return in the next couple of years. Again, I think if you're looking at somewhere in the mid 23 or early 23, I think that's where you'll see the sharp turnaround from there, because the cycles have become much sharper. And as we peak out, if we peak out in interest rates by December itself, we will see the price turnaround much faster. So it depends, all depends on how faster the interest rate cycle peaks out. The question is, what kind of ratio you should have actually, as why the ratio of 30% gold and 70%, why should not be like. So looking at the returns, this is the last 5 years returns, including 22 estimated the current YTD returns. Is typically you've seen 19 and 20, we have seen a significant return in gold silver. Normally 25-30% year on year growth in prices is normally not seen. So you can see that if you see gold, 14 to 15% is the average rise in prices in a bull period. Overall, if you look at a 10-year or a 15-year period, gold will give you around 12% to 13% CAGR, whereas silver will give you 30-35% CAGR, depending on where you entered. But it's extremely rare to see 2 years consistently gold and silver going up by 25-30%, in excess of 25%. So 19 and 20 has seen that. Again, 20 has been driven by pandemic and also continued liquidity infusions, which has happened post pandemic also. So the significant returns happened, which is 19 and 20 has slowed down in 21. So that doesn't mean they have actually turned around or it has been bearish, but it's in a marginal correction or have gone into that consolidation phase after a large price increase in 2 years before that. When you look at this chart, which is gold and silver price charts, you can actually see the gray line of silver. When it falls much steeper than gold. And when it rises much faster than gold. So at times in a bull trend, it performs significantly higher than gold. And in a downturn, it actually performs, it also falls much larger falls. It displays when the market goes into a downtrend. So that's what the tendency of silver itself, the nature of silver itself is that. So that actually makes us, if when you're introducing silver into that portfolio, you should be able to control this volatility. So the ratio is something that you should have much lesser ratio of silver compared to gold, because silver adds more risk, but it also brings more returns to the table. So you can't ignore that metal. In order to control that risk and return, I think the 30-70 rule significantly helps. So this is one chart I just put it down for the last 5 years, 2017 onwards. If you put a 100 rupee on gold and silver in different ratios, I put 3 different ratios, gold and silver. So the 30-70 is gold 30% and silver 70%. 50-50, that's equal portions of gold and silver, and 70-30, the 70% gold and 30% silver. So you can actually see how these 3 portfolios performed over the last 5 years. And you can see this gray line has been a consistent outperformer in all the 3 scenarios till now, right? So that actually makes it a best case that if you are actually holding a 70-30 gold silver, that actually is a better way of incorporating this into your portfolio at this ratio, rather than actually having equal amount of gold silver or more silver. So at times in a bullish periods, the blue line rises much faster, but it also comes with that volatility and risk. When it falls the fastest. So to avoid that volatility into your portfolio, 70-30 acts as a best possible ratio of having these 2 assets in your portfolio. So that's it from my side actually, and Chirag will add more insights onto this.
So the first question, why do you think that all these wealthy people or rich people globally, they are investing their wealth and holding their wealth in gold and silver? Any thought on this?
See, again, as I said, because gold and silver has a unique properties actually, which they bring to the table. One is whenever you lose confidence on fiat currencies, either it could be dollar or any of the currencies which the people are holding, they actually tend to turn to the real money. So gold is called the real money. So the ultimate currency, where it, as you said, gold actually doesn't change its value a lot. So it changes its price, but not value. So it's a statement I want to explain, because, for example, as you said, that if you go back 100 years back also, the gold value and today's gold value is same, because it would be able to purchase whatever the with 100 grams of gold, whatever you could have been purchased 100 years back, today also you'll be able to purchase the similar goods and services or whatever you want to do, but the price is completely different for what 100 years back and today. The change is what it is measured in. What it is measured in, it's measured in dollars, it's measured in rupees, it's measured in euros or whatever. The measure keeps on changing. The measure's value keeps on changing. So the moment you measure 100 meters with a 1 meter scale, you'll get 100, and you cut the scale into half and now measure the same distance, you'll get 200, right? So that the distance didn't change. Actually, the measure shrunk. So the measure itself is the dollar. So as the currency's value shrinks, the value of gold, the price of gold in those currencies increases. So that actually protects anyone's purchasing power. And the rich and mighty always know that threat is always there in any currency. So whenever they see there is a indiscipline in fiscal indiscipline in any of the countries, and monetary indiscipline, and too low rates and too high inflation, they tend to migrate their wealth into gold or even silver for that matter.
Yeah, I agree. I think JP Morgan says that gold is the real money and everything else is credit. I think that answers.
Yeah.
Right. Great. I know we talk about gold all the time. Okay, but silver is also a precious metal. Okay, so some light on precious. Of course, you covered few things. But in industrial landscape, where do you see silver is being uses, and any outlook on that, or is there any new industries which are coming which are also going to use this metal?
See, as we are progressing into an era where there is a huge emphasis on green fuels, a huge emphasis on environmental sensitivity, the investors are recognizing that they are rewarding those companies which are sensitive to those issues. So the solar is going to be a phenomenal consumption area of silver. there's a lot of battery technology where silver is becoming a critical component. All these chipsets and typical low-end processing power, low-end small transistors, or we can say the circuit boards, the PCBs, especially in the white goods, especially not the high end. So when you're going to high end like mobiles, mobile phones, and laptops, etc., gold becomes the preferred metal. But when you come to a lower end tech like washing machines and so on, so white goods, where they are becoming smarter and where they are also going to be having chips in them, those silver is the preferred metal to draw those circuits on those boards. So these are the two: tech and the green energy is going to be a big driver for gold, silver in the coming days.
Yeah, great. Thanks. Now, the ratio which you also recommend and the product which you're also going to discuss is also a 70-30 ratio. Okay, but if my view is very positive on silver, which I think that silver will do is of course my personal. Any investor may be thinking that because of all these new technologies, including your medical equipments, all the green technologies, silver may be having higher demand. So how does that 70-30 play as a role? Does it help me in returns? Does it help me in volatility? Some light on that.
Yeah, to be very frank, even our house view is also that we are very bullish on silver, actually. And we think that it will significantly outperform gold in the next couple of years. But when I see an ETF investor is not a tactical investor. ETF investors are normally a long-term investors who are looking at a much longer term. So they might be looking at 5 years, 7 years down the line, at least beyond next couple of years. So when they look at their portfolios in such a manner, we also need to see how the volatility impacts an investor, because when you say that we are bullish on silver and tomorrow go and buy silver and suddenly it falls by another 10%, the investor's confidence shakes out and he gets out of the market. After that, it might rally whatever. It doesn't mean because he's not participating anymore. So to control that volatility in the portfolio and keep them invested, I think the ratio works beautifully. You also participate in silver and you also participate in gold. At the same time, both are tech related. Demand is coming up. Whatever the demand currently we have is financial demand, which has shrunk. The tech demand has not shrunk in either of the metals and actually is increasing. Only in this higher interest rate scenario, the financial demand goes down as an investment demand goes down. So that investment demand is very, very fast in turning around and coming back. The moment the scenario changes, all the money will turn around. So I suggest rather than holding gold itself, which will give you much stable returns than this ratio, but at an overall portfolio level, it will be having a lower return. But if you go 100% silver, you add a significant volatility to your portfolio. So I think a better risk-adjusted ratio is 70-30. Incidentally, we also have a similar index on MCX, which is called Bulldex, which is in a similar ratio. And that also reflects that this is a better ratio. Even when I showed the chart over a period of 5 years, also it shows you a better performance.
Yeah, great. I think that takes me to the next question. You just said that during this high inflationary period, we say interest rates going up. Okay, during this time, how do you see both these metals doing? We also saw gold also correcting. So, any thought on that?
Yeah, gold has corrected significantly in international markets, but in domestic side, we are still not that down. Actually, I think 10-12% we're down from the top. But fortunately, what helped us in domestic markets is, number one, the rupee depreciated from 72 to 82 in the last couple of years. Not even couple of years, 18 months to be very precise. And also, Indian government has hiked its import duty on gold to 15%, 15.5%. which actually 5% push, at least 4.5% push came from there. So that's an additional benefit which is caused to Indian investors. So we got a significant cushion there. Uh, do we expect a duty to come down anytime soon? No. Second is that the currency depreciation should be halted here. I don't think so. So we will see rupee depreciating further from here, and there's been government is still seeing it that though we know that there's a lot of smuggled gold which is coming into India due to the import duty arbitrage, but still government is not in a mood to decrease or take a view on the duty at this point of time. So I think our returns will be slightly protected here, despite interest rates rising. And I might expect the prices to be stable and slightly, even moderately lower also in the next coming 6 months. But again, I see that in this kind of investment funds, probably if you prefer, if you want to time it out, it will be extremely difficult to time. We are down almost like 15% from the top. So you are getting at a much bargain rate. Probably if you are still doubtful, probably you can subscribe for an SIP kind of a or periodic investment in this in the fund of funds, so that you can actually regularly keep funding that, and in the next 6 months you will be able to average it out. So that could be a better way of looking at it.
Yep. Yeah. So still you feel that, in this inflationary period, both these metals will do well.
Certainly, absolutely, they will do well. So the only thing is, as I said, the timing. So the moment the bulls or the turnaround in the price will happen once the turnaround in the interest rate cycle happens.
Okay, great. That takes me to the next question, which you just mentioned. We Indians hold gold, kind of a quasi dollar.
Yeah.
Okay. So some light on that, the correlation on dollar and these metals, and where do you see, so if dollar continues to have a rally from here, what's your view?
See, our internal view on dollar index is around 124, 125. So it could be a radical number. Chirag might be surprised looking at that number, but so we are right now around 111, 112. So 125 is like still a long way to go, which takes our rupee conservatively close to around 90 plus. So rupee depreciation is going to continue. The moment because see, we have been trying to contain the rupee under 80 for a long time. We almost spent $100 billion on interventions, etc. But we have realized that it's not possible. We're trying to now. RBI is coming with few schemes to save it from here also. But my idea is, I think we will not be able to do much there. So we will import some inflation into India. Right now, we are not struggling with inflation. We will import some inflation. We have off late, the crude prices have cooled down a little bit. But still, the Ukraine conflict is still very much on. Global supply side issues have not sorted out. And the demand is still very strong. Excluding in a few commodities like energy, where we are seeing some softening in demand. And China has actually softened demand over, especially last couple of months, due to the COVID-related shutdowns and COVID-related lockdowns. So they are coming back actually, but in the next a month or 45 days or a couple of months, I see China to bounce back on the demand front. So that actually will cause another commodity price spike. So that way, inflation is very much here, and it will further tighten, further rise from here. So as a protection against inflation, I would definitely suggest whatever your investment portfolios is, see, gold as a part of investment portfolio depends how much gold or precious metals you should have. It ranges from 10 to 15% depending on what age bracket you are at and how much risk you are going to take. But this ratio can go up to 30-35% when you have high inflation and when you are threatened by the currency depreciation. It can go down to 5% also when you have an extremely positive equity market environment. So, but you cannot have zero, you cannot have 100%. So I would suggest at this point of time, my personal suggestion will be you should be having anywhere between 15 to 20%. I'm not saying 30, I'm not saying 5. So a 15% portfolio allocation should be there, because that's where we are there. We are seeing some positivity and some positive returns still in equities and risky assets. But at the same time, your cushion should be slightly higher in precious metals. At this, you can't build cushion once the price turns around. You have to build cushion when the prices are falling. That's what the point is.
Yeah, that helps. Now since you already clarified about the percentage in the portfolio, if I can ask, of course you already covered in your presentation, but for few you viewers might have joined late. What's your view on both these metal for 1 year and say 5 year? What kind of returns do you expect?
I think 5 year we are looking at 30-35% return in gold, around 60-65% in silver. But 1 year we might see negative 5 to 7% in gold and 10-11% downside in silver. Given if the rupee doesn't depreciate, if the rupee depreciates, the fall will not be that much, because I am feeling probably 84-85 RBI will try to defend it from here onwards. But if we are breaking those levels, so 87, if 87, 88 is on the cards, then probably we might see 5% decline, not much more than that.
Yeah. Thank you so much, Kishore. I think this clarifies the percentage of portfolio for in this precious metal as well as the returns which you can see. So long term definitely looks good. Already it's been corrected. It's a good time to invest. That's what Kishore is talking about. So thank you so much, Kishore, for coming in here and giving your insights. It was definitely wonderful. It's a good discussion having with you. Thank you so much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.